there's an awful lot going on, and so when I stopped to think about what I should talk about today, it was hard to narrow it down. But I was mindful that this is an investment-focused conference, and so rather than the broad skate across the APRA regulatory landscape, it was probably more important to give a bit more focus on investment-related issues in my comments. So I will start with a few observations on industry context and challenges, and then I'll probably spend most of the time talking about some observations from an APRA perspective on assessing performance and member outcomes, and teasing out the different ways in which we would encourage the industry to think about that, and in particular ensuring that the assessment approach and assessment of performance uses measures and methodologies that are appropriate for the purpose of the assessment that's being undertaken. And then I'll just finish very briefly with a quick summary of the key areas on which we'll be focusing over the next year. But if we start with context, I think, those of you, again, that have been working in this industry would know that the profile of the industry is changing and has been changing over a number of years. And what I've tried to show on the next couple of charts is just what some of those key demographic and other changes are. So we have an ageing profile. I think that's recognised and it's been talked about a lot by the industry for a number of years. And what these couple of charts show is that the total member benefits by age has been progressively increasing, but also increasing quite steeply in the proportion of benefits held by older age groups. And similarly, the average account balances by age have been trending up over the last 10 years or so, and we expect that to continue. Now, those changes in member profile and account balances in older age groups have a number of implications that trustees and funds need to think about in terms of, for example, the investment strategy that might be appropriate where you've got an increasing proportion of older members with higher account balances, what it might mean for aspects of your benefit design, particularly in relation to things like insurance and post-retirement options, and we've had a couple of sessions already, I know, on post-retirement options. And then there's also the issue of advice needs and the communication and engagement that's needed with your members and how you tailor that to the different groups and particularly to those older age cohorts where there might be some different issues that are of interest. Of course, in terms of the ongoing sustainability of the industry and the individual funds within it, the relevance of an ageing profile and what's happening with those balances and where the money rests is most evident in what's happening with net cash flows. So what we're seeing is an increase in the absolute dollars of benefits that are being paid out of the industry. So we're seeing that shift of members from the accumulation to the outflow stage, both in absolute terms but also as a proportion of the contributions that are flowing into the industry. And so that clearly has implications for the net cash flow profile for the industry in aggregate, but also for individual funds. Now, how those factors play out for individual funds will vary quite widely, because we know, and you would know, that there are some quite widely varying profiles across the industry in terms of the age profile of individual funds, the size of both absolute and average account balances across funds, and hence what that means in terms of the net cash flow profile. So we have a mix of funds, some with very strong net cash flow positive profiles and others where the net cash flow position is deteriorating, and I've got some more slides on that later. So what that means is that really all trustees need to be thinking about the specific aspects of some of these context and environment issues for their fund in particular, and what that might mean for their investment strategy, but also for other aspects of their operations, and whether there are any changes that are likely to be needed. So obviously if you've got slower growth in assets or members or a negative cash flow, then your ability to generate the funds that are needed, for example, to make the investments in systems and processes to be able to deliver the services and benefits that you want is going to be potentially more challenging. Obviously, a net cash flow has implications for, a negative net cash flow has implications for investments, investment strategy, liquidity needs a careful consideration, the appropriate asset allocation when you've got a different risk profile for your members because they're in different age cohorts is important. So, does the risk return target and benchmarks that you've set and the underpinning asset allocation for that need to be revisited? So we think it's important that all trustees are thinking about those and thinking about the challenges that lie ahead. And from our perspective, and some of the communications we've done recently with the industry around having a focus on future sustainability means that we expect trustees to be proactively looking at and thinking about these issues, and in particular how they're going to continue to deliver quality value for money outcomes for their members, not just now but over the medium to longer term as well. So we've increased our attention on how trustees are going about this and the sorts of processes that they have in place for both strategic and business planning and monitoring performance against plan, but also in terms of how they're assessing and the measures that they're using, the benchmarks that they're putting in place. Because if you haven't got appropriate monitoring against the right benchmarks, then you're not going to be able to see whether you're on track or not and be able to change course as needed to correct any areas where you're not delivering value for money or quality outcomes. So we're using a range of tools to do this, and I appreciate that you won't be able to read the detail on this slide, but it's really to give you a sense of the approach that we're taking to looking at this from an industry-wide perspective. And those of you that were at the recent As for Policy roadshows may have seen this slide before. It's really just showing we've got a number of metrics that we're looking at, and we're assessing performance for and outcomes for members across that range of metrics, and we talked a little bit about this both in an Insight article released in July and in the letter to industry that we released last week. And what we're trying to do is to get a sense of where are funds performing well against benchmarks and where is there room for them to improve. And so this heat map chart shows, and it's only a sample of the industry, a green box shows that on that particular metric a fund is in the top 25. A red shows that on that particular metric they're in the bottom 25. So what it's showing is that firstly we are looking at quite a range of measures, and we listed what those measures were in the letter that we released last week. There's a focus on investment returns looked at in a number of different ways. There's costs, there's cash flows, there's growth, there's other dimensions of membership that we're looking at. And the other important observation to make is that in most cases, funds are not necessarily good across the board or poor across the board. There's a smattering, and so it shows that in some cases funds can be performing well in one or two areas, but perhaps have some room to improve in other areas. And it's that overall picture that, in terms of thinking about outcomes for members, we think it's important for us and trustees to be looking at. We're doing this across the whole industry. We've highlighted the funds where they're looking red across multiple metrics as a set of funds where we're having a particularly heightened focus at the moment. And those funds represent a mix of small, medium and larger funds across the whole of the industry, irrespective of industry segment. In terms of some of the nuances of assessing outcomes, I think I want to emphasise a number of points about this concept of making sure that the assessment measure and methodology is fit for purpose and suits the purpose that you're looking at. So from our point of view, no single method or single metric is going to be the indicator of whether a trustee is doing its job well. And the next couple of slides really just show you a few ways in which we're looking at this in more detail. So this particular slide is comparing the net cash flow over the 3 years from 2014 to 2016 with the net cash flow in the most recent year, and gives a sense of what that is in terms of absolute terms, but whether it's improving or deteriorating. Now clearly, funds where they're in a poor net cash flow position and that position is deteriorating are going to be of considerable interest to us, and we would expect the trustees of those funds to be thinking about what they're going to do and what the implications of that deteriorating position are. And so this approach is appropriate for looking at that dimension of performance. But if you were thinking about other dimensions of performance, as I'll get onto in terms of talking about investment performance, for example, then you need to look at a range of different measures to assess the underlying drivers of investment performance or the implications of a change of investment strategy. So assessments also need to be dynamic. You can't just look at something once and then assume you fixed it and move on. You need to keep updating, and so we will certainly be doing that in our analysis. In terms of looking at a combination of factors, one dimension that we look at is returns and costs. And again, in broad terms, if you've got a low performing fund that's also high cost, then that's going to hit our radar screen, and so that's what that top left box is all about. But again, I think it isn't just about having low cost. You need to look at this whole package of elements in assessing performance, and we are certainly not promoting or advocating the notion that lower fees is an essential aim or lower cost is an essential aim. It's actually about ensuring value and appropriate outcomes for the costs that are incurred. And indeed, in some respects, enhancing the overall long-term member outcomes can be achieved by improvements in education and services and advice and the like, looking at helping members make more informed and more tax-effective investment decisions, and that can have a more material impact on outcomes for members than relatively small reductions in investment or admin fees. So, you know, keeping fees low is a good objective, but it's not the be-all and end-all, and in some cases actually having slightly higher costs that provide the right investments in services and benefits for members can actually do more to enhance overall effectiveness and member outcomes. So, similarly, as you would all know, higher cost investment strategies can and often do deliver higher returns in the long term, and so just looking at costs on face value isn't necessarily the right thing. We would also advocate that you need to look at both absolute and relative measures, but also importantly compare against appropriate targets and benchmarks and think about risk-adjusted returns. You need to look at range and variance, not just averages. Someone used, I think it was from Queensland Investment Corp, talked about the concept of being peer aware but not peer anchored, and I think that's really appropriate. Yes, you do need to understand where you're positioned relative to peers, but you need to think about the basis of that peer comparison and make sure you're making like-for-like comparisons, which is something that we have talked about and was a particular focus in the July Insight article. Risk-adjusted return is clearly important. Again, the concept of comparing a low-risk investment strategy with a high-risk strategy just doesn't make sense. There are good reasons why funds and trustees will have different risk-return objectives to suit their member profile, or because they've got different options that compare that offer a range of different investment strategies and risk levels for members to choose from. And so when you're doing comparisons, it's important to look at what you're comparing to and make sure you are making a like-for-like comparison. So this chart is simply just showing by risk label, based on our data, what the actual experience for MySuper products over the 3.5 years to date has been. It's kind of pleasing to see that the trend in terms of median performance by risk is in the right direction. It's also probably not surprising to see the range of variation in performance around that median, and this is something that we would be looking at as part of our assessment. So I've got 1.5 minutes to talk about the next 12 months, but I've really covered a lot of it already in terms of talking about APRA's focus on sustainability and member outcomes, looking at the practices across the industry around strategic and business planning, looking at how trustees are determining whether their business operations are delivering quality value for money outcomes for members, and whether they're going to be sustainable into the future. And we're using the range of tools and supervisory approaches that I've touched on to do that. Obviously, hopefully you're all aware about the policy reforms that are in train, and so the government has announced a range of measures, and APRA has also arranged some areas in which we are looking at proposals. All of those proposals as a package are about improving transparency and accountability across the industry and about enhancing practices around the way members' money is being managed by the industry as a whole to support better outcomes for members. There will be a range of reporting changes that are needed to support those reforms, particularly in relation to expenditure, which is one of the proposals that was in the draft bill that was put out for consultation, but also to address some of the other areas where we've identified, and you have told us over the last few years, that there's room to improve the quality and the consistency of information that's submitted to APRA and also published and reported. Those reporting changes are relevant to many of you in this room, because trustees will need to rely on the fund managers and their other service providers to provide some of the more granular information that we think is needed to support the enhanced transparency and accountability that's expected. So we will be undertaking extensive industry consultation over the coming months on those proposals so that they do work for industry and deliver the outcomes that are intended, and we will be telling you more about that in the coming days and months. So I need to end here. I think I wanted to just finish with a comment, which is that, after 25 years, and there was a recent sort of Chant West note along these lines, the superannuation industry has a lot to be proud of, but our view is that there's no room for complacency. It's important that the industry continues to look for opportunities to enhance its practices, its efficiency, and what it's delivering for members over the long term. And so we're working with you. We want to work and continue to work with you to support your efforts. And our focus will always be, and always has been, on encouraging everyone in this important industry to seek to improve what they're doing for the benefit of their members. Thank you.
Well, good morning, ladies and gentlemen, and thank you for the invitation to come and speak with you today. I have a few prepared comments, but I'll be delighted to take any questions following the presentation. Certainly there is, and I would echo Helen's comments, there's a lot going on in the regulatory space, both derived from an international and a domestic agenda. I'd like to briefly touch on a few issues that I think are relevant to the investment community from an ASIC perspective. Three areas in particular: financial benchmark reform and BBSW, fees and cost disclosure, unsurprisingly RG97, and some work that we're doing on performance reporting. Now, just on that first topic, the Australian government and regulators are currently undertaking a significant effort to implement important financial benchmark reforms. And ASIC has assisted the government with draft legislation and consulted on proposed benchmark rules, which will make if the legislation is passed. Now, these reforms are very important to promote the integrity and resilience of key financial benchmarks used in our economy. It would also help to ensure that cross-border transactions that use these benchmarks can continue once the European benchmark regulatory regime is in place from January 2018. I'd like to focus today on the work on the bank bill swap rate on BBSW. ASIC, RBA, APRA have been working very closely with industry to ensure that BBSW remains a robust financial benchmark now and in the future. A key part of this work has been to strengthen the BBSW methodology to enable BBSW to be calculated directly from bank bill trades by a wider range of institutions during a longer trading window. The methodology will require bank bill market participants to trade at outright prices rather than at the BBSW rate that will be set on the day. This includes buy-side institutions such as funds. We recognise this will be a significant change for many market participants, including superannuation funds. We strongly encourage everyone to support this transition and to take part in the process. It's not just because this change would help to strengthen the BBSW, but because it can help fund managers and superannuation trustees to demonstrate that they have fulfilled their fiduciary obligations by seeking to negotiate the best price they can get on each bank bill transaction. To support this change, ASIC, as the administrator of BBSW, has been working with market participants on a new set of guidelines on trading of bank bills during the window. We in the RBA have been keen observers and are also very supportive of this work. We certainly hope that the trading guidelines can help give market participants the confidence to start trading bank bills at outright prices. We recognise this will involve some significant process and system changes, not just for funds, but also the banks and even the Reserve Bank's open market operations. We believe the changes will be worthwhile so we can have a more robust BBSW, which will benefit everyone in the Australian and global markets. I'd like to turn now to some more super-focused issues. Now, certainly I don't need to tell anybody here that we've been undertaking some considerable work in the area of fees and cost disclosure. What I'd like to do is briefly take you back as to the rationale for why we did this And in particular, I would commend to you a review of our report 398, which we issued some time ago, and which has driven the changes to RG97. In this report, we identified, and I should flag that this was a report that was derived as a result of some areas of industry flagging that there were concerns in terms of potential gaming of fees and cost disclosure. We identified areas of under-disclosure of fees and costs associated with investing through interposed vehicles. We also saw under-disclosure of transactional fees and costs and the reduction of disclosed fees and costs by tax deductions to which a fund may be entitled. As a result of this, we updated RG97, and through a very long and consultative process, RG97 was reissued towards the end of 2015 with an initial implementation date of February 2017. Now, you'll be aware that for those that wish to obtain relief to the end of, to the 29th of September, relief was available under certain conditions. One, that we were to be notified that you were making use of the relief, and secondly, to provide some data to ASIC. For the approximately 90 trustees and issuers that met the conditions before the 1st of March, the transition period was extended, and this was to allow industry to additional time, which had been requested, to meet some of the implementation processes for that have been identified in terms of system changes, for example. For those remaining trustees who did not meet the conditions, the transition period ended from the 1st of February, and the PDS would need to be compliant from that date. Now, in terms of the data we received approximately 2,000 investment options across superannuation and managed investments. And based on our analysis of the data, there was an increase in total fees and costs disclosed of super funds, but the level of increase varied between funds, and in particular between products within funds. Some funds reported very little change, while some increased by more than 100 basis points. For my super product, the average increase was about 23 basis points, which is equivalent to $115 of additional disclosed cost per annum for the $50,000 example. One other thing that the data demonstrated was that the level of variability in terms of the current versus the calculated was not as extensive as sometimes being reported, which indicated that there was actually more consistency than has sometimes been suggested will take place as a result of the changes in RG97. Now, we've continued to engage with industry on these issues, and a common line of inquiry is related to the inclusion of transaction and operational costs and the indirect costs, and also in particular areas around the reporting of property operational costs. Now, you may be aware that we recently extended, particularly for ongoing property operational costs, we extended the deadline until the end of September 2018. This was in response to issues that have been raised to us by industry about implementing that particular aspect, and also some other areas which I'll mention a bit later. We're very conscious that there is a need, and we want to work collaboratively with industry to ensure that the implementation is successful. However, the vast majority of RG97 requirements will be effectively operational from the end of September of this year, 2017. And we encourage industry participants to ensure that their PDSs are compliant. With this very specific and defined area of extension, we're trying to address those points that have been raised by your industry association and others that were identified as being particularly problematic. Now, the reporting of transaction costs is important, we consider. We understand that there are issues and perceptions of how this might impact in terms of competition between funds. But we are very conscious that in terms of the use and the inclusion of transaction costs relating to property, that a trustee needs to be aware that they have to ensure that they are articulating their investment strategy effectively to their investors. I'd like to turn briefly to talk about platforms. Excuse me. Now, contrary to some statements that have appeared in the media, there are no carve-outs from fee disclosure from platforms. To ensure that retail investors are not misled, a platform PDS will need prominent statements following the example of annual fees and costs. The PDS will need to show that the fees and costs of the platform relate to the access to the investments on the lists, and that the additional costs will be charged by the issuers of these products. Similar disclosures will be needed when covering fees and costs in an IDPS guide. Providing an example to illustrate the combined effects of fees and costs of the platform and of the actual and hypothetical entity that may be regarded as typical would be a good approach. An example should be given in terms of its fees and costs and investment strategy for a major proportion of the investments selected by investments in the relevant platform. We encourage platform operators to provide similar examples of the cumulative effect of the fees and costs for each investment in the list, taking into account the fees of the platform and the fees and costs for the investment that may be selected. This information should be based on what is known, or to be known, or can be reasonably estimated, and costs in such disclosure will usually be based on the last financial year. In marketing activities or financial product advice that refers to fees and costs for investment options which involve platforms, they will need to ensure that there is no inappropriate comparison with other kinds of investment options. For example, it would likely to be misleading to compare an investment option where the noted fees and costs don't also include the fees and costs of gaining exposure to the option via the platform. I would emphasise this, that we are seeking to provide, through the changes to RG 97 and taking in context the broader regulatory environment, a level playing field between all forms of investment. And our experience in terms of the data that's been provided is that there is greater consistency as a result of RG 97. At FLAG, we've also made a recent decision to defer some specific disclosure requirements which apply to periodic statements. Borrowing costs for superannuation product, subject to requirements for inclusion of details about how to obtain information about borrowing costs. Disclosure in the total of other fees and any amounts by which tax deductions have resulted in reduced disclosed fees or cost. And in terms of the buy-sell spread for superannuation products, the periodic statement should state that it's not included as it is reasonably practical for the trustee to include the buy-sell fee that the investor incurred during the period. We're currently working with industry, and the industry working group in particular, to work on a revised class order that will give this a temporary deferral effect. Now, to assist implementation, we have published and we will continue to publish questions and answers on our website to complement the guidance in RG 97. We invite you, should you wish, there is a link on the website to send in any particular questions that you may have. As I mentioned, there is an industry working group, and we're working very closely both in terms of understanding industry's needs in terms of the regulatory guidance, but also to encourage the development of industry standards and guidance in this space. And we've been very encouraged to see that there is good progress being made in this particular area. I would emphasise that after the transition period completes at the end of September, we will be undertaking compliance checks to determine the extent and to ensure that there is compliance with the RG 97 obligations, and in particular with areas that may be considered to be potentially areas of concern where, as I mentioned before, there is full disclosure of all the costs. I very briefly now like to turn to another area which is about performance reporting. We're very much aware that fees and costs is not the only factor that investors should consider when making investment decisions. Asset allocation, investment objectives, strategy and risk are clearly also important, as is the availability of services and offer like advice and online accessibility. One area that we're particularly interested in seeing is that in terms of where we are, the focus should move towards looking at net returns, and a consideration that if we have consistency and accuracy in terms of fee disclosure, we should look to have similar consistency and accuracy in performance disclosure, and the focus can then shift towards what are net returns. To this end, we're undertaking a project to better understand industry practice in relation to performance reporting. We're currently undertaking engagement with industry and discussions with particular industry associations and industry participants to gain a better picture of what is happening within this space. I'd be delighted and would encourage you to contact us if you have particular views about how performance is reported, how it's defined, and how investors may understand and make use of the performance information. We'd like to hear your view. Now, I'm very quickly running out of time. There are just a few areas that ASIC is looking at within the superannuation space and more broadly within our financial services remit. In the super space, I just flagged that we do have other work underway which may have an impact subsequently. For example, our work on employers and super, and our post-retirement work as a component of ASIC's overall work with regards to older Australians. In the fund space, we have issued regulatory guidance on risk management for responsible entities quite recently, and we're working furiously in building the new regulatory regime that will sit around the Asia Region Funds Passport and the new corporate collective investment vehicles. There's a lot going on in this space. There's a lot going on in the super space. There's a lot going on in the fund space. And we would be delighted to hear your views on the developments in each of those regimes. We will shortly be issuing consultation on the CSIV regime in particular. I'd like to close there. I would echo the points that Helen has made about the importance of the superannuation sector as a whole and the superannuation industry in delivering to superannuation members. Thank you for your attention. Thank you.
Thank you, Jed. Thank you, Helen. Time for questions now. Does anyone have a burning question they'd like to ask from the floor? I do have questions coming in via the app. I might just start with a quick one off the back of your presentation just then, Jed. You talked about compliance checks in relation to RG97. What happens in the event that there is non-compliance?
Okay, so we have, in any normal circumstance, we have a range of options that we can take in terms of what is the level of compliance. So there are aspects of, depending on what the issue would be, we might seek to have corrective disclosure in the first instance. If, for example, there is persistent non-compliance, we do have stop order powers, so we can require that the PDS that is deficient is taken down, and marketing would need to cease. Ultimately, we do have more broader powers than that. I think it's quite interesting when we look at some of ASIC's powers in the space more generally, and there are often questions about how far we can go in terms of product intervention. But from a disclosure perspective, we do have a broad range of options.
Okay, great, thanks. We've got a question over here.
Hi Jed, hi all, it's Sally Rose from Investment Magazine. My question's specifically for Jed, and that is, and excuse me if this sounds daft, but I don't 100% understand your description around how platforms are not carved out from RG97.
Sure.
And so I was hoping maybe if you could just run through that a little bit more to clarify, because it's just genuinely not quite clear to me.
Yeah. So if you look at RG97, it's talking about the PDS disclosure, and so there are certain tests to define what is an interposed vehicle. If something is defined as an interposed vehicle, there is a requirement to then roll that up into the overall PDS. If you're accessing it through the platform, there isn't necessarily quite the same requirement, because that has already a disclosure in their existing PDS. So what you would be required to do is to disclose and this is the issue that has raised some concern, is that there would only be a disclosure of one or the other, but you are required to disclose both. It would be misleading if you didn't disclose the costs of using the platform to access the underlying PDS. So that's where I think people have looked at it and said, in the context of how does this work, it's looking like if you've got an interposed vehicle that somehow, if you're accessing it through a platform, then you'd never have to disclose those costs. And that's where we're saying that is not the case. There isn't a carve-out, because you've got to look in the context of the overall requirements.
So a popular question here on the app: do APRA and ASIC make an assessment of the costs of implementation of new regulation and weigh this against the expected benefit? Because there is obviously a lot of demand on funds and a lot of cost that is associated with that.
Absolutely. I mean, it's a government requirement that there are regulatory impact statements and cost recovery income statement requirements for major policy changes, and it's a discipline that we have to undertake, and we have to report to government against the regulatory burden that's being imposed, and any offsets that we might be making in other areas. So if you're adding something on, is there an opportunity to take something off? The challenge that we face is actually getting good cost information from industry. We often ask in our consultation papers, and maybe people ignore it because it's a standard section, but we ask for them, for you, industry, when you're responding to consultations, to tell us what the implementation and ongoing costs of regulatory reform are, and we very rarely get any meaningful information. And so that means it's very hard for us to do a rigorous cost-benefit analysis. So I would encourage you to give more thought to giving us information on implementation and cost burdens in a genuine way, and that will help us get better at managing some of those considerations.
I totally agree with that. I mean, I just add that the regulatory impact statements are published. You can see what the cost benefits analysis that's undertaken. When we do a consultation, there'll be one of the associated documents. So if you want to have a look at what the proposals have been, we'll have a feedback statement that will take into consideration what's the outcome of the regulatory impact statement, the feedback that we've received, and then the conclusion that we've drawn to take the step forward that we will do with the regulatory changes.
And probably the other point to note is that sometimes it's actually quite hard to put a cost assessment on something that is rather qualitative. So if you're focused on improving governance or improving culture in the industry or those sorts of things, getting a sense of what the benefit is in any sort of meaningful qualitative way can be challenging as well.
The member wants service, so these are the people in the room obviously that know what their members want. They want service, they want security, they want advice, and they want strong performance. Where are they being measured?
Well, we would argue that that's what we expect to see covered in the outcomes assessment that's undertaken the My Super product level, and also for products and funds more generally. So there needs to be, the trustees need to be looking at this, and we need to be looking at it as well in terms of what are the assessment measures that are used for all of the elements of what the funds are providing, and how is that being drawn together to give a view about the quality and the outcomes that are being delivered. There are a number of dimensions to it, and I endeavoured to paint that broader picture in my comments earlier today, because it is important not to just focus on one single aspect.
Yeah, I absolutely. I mean, from a disclosure perspective as well, it is how you're saying that's what your members want, and I wouldn't necessarily disagree with that, but also it's about how you engaging with your members to ensure that you're delivering what your members want. It isn't necessarily a regulatory solution that is going to drive that. It's about the role that you perform in terms of interacting with your membership base.
Just a question, I guess, in relation to ESG, this being an investment audience. What are your respective approaches, I guess, to ESG? What do you think of it, the fiduciary obligations, and what about screening out investments such as tobacco and coal? What do the regulators think about that?
So from an APRA perspective, there's a clear obligation for each trustee to set the investment strategy for the funds under its oversight, and there are many ways in which you can develop an investment strategy to deliver outcomes to members. And so we would see ESG considerations, and whether you screen in or screen out or how you do that, as just part of the consideration of the investment strategy for either your default options or your broader choice options. And so, you know, in any investment strategy, you need to think about risk, you need to think about return over the medium to long term, and draw that together in a way that's going to deliver on the outcomes that members should be getting. And so there's no constraint in our mind on having ESG or other considerations as an objective, as long as it's considered in the context of the investment strategy, and those important sort of risk, return and other considerations are being weighed up appropriately.
And I think from an ASIC perspective, I think that's more of a question that APRA would say from looking at super, but we're looking at very similar issues in terms of corporates and other types of entities, and certainly they are areas that we would have a similar perspective. I think it's important as well that people bear in mind that this is going to become more and more of or appears to become more and more of a focus, in that people are determining what they would want their super fund to do, and the more in terms of the disclosure, that more people have access to information about what the super fund is actually doing is going to drive a lot of this change. So I think it's a front of mind type of issue.
And there's an alignment between what you say you're doing and what you are actually doing.
Helen, in terms of choice and my super investment options, do you think there's, you know, from a regulator perspective, that choice should have less supervision on it than default my super investment options? Because that seems to be, I guess, the message that's coming out to the industry.
Well, that's not our view, and I guess it depends what you mean by less supervision. There are obligations on trustees of all funds, whether they're offering default funds or offering choice funds, to meet their fiduciary obligations under the SIS Act, and including how they construct and deliver investments. And so there's some nuances in the requirements, because there's some more constraints, if you like, on the default area in terms of how you frame the single or life cycle type investment strategies. But even when you're looking at choice investment strategies, you need to make sure that those options that you're offering are appropriate for the members that are taking them up, and have some frameworks and processes in place to make sure that ultimately those offerings taken together are delivering reasonable outcomes for members. So in our view, those obligations on the trustees are quite consistent and quite similar, and our approach to oversighting that is equally quite consistent and quite similar. But you do need to bear in mind that there are some slight differences when a member, as long as they're fully informed, is choosing to go, you know, perhaps low risk, higher cost versus default, where you want a little bit more sort of care and diligence by the trustees around what that default option is. But in principle, no material difference from our perspective.
So in terms of the funds that you're starting to identify against those criteria that you put up before, those that are in the red boxes rather than the green ones, is APRA looking to use its existing enforcement powers at all with any of those funds?
Our goal is that we would be able to get those issues addressed without the need to take enforcement action. So the initial point is a firm conversation about where we see the areas that need to be addressed, and giving the trustee, putting the onus on the trustee to come up with a credible strategy to address that. There are many ways that strategy could play out. It could be improving performance, it could be looking at transfer of the members to another product or another fund or the like. So if we don't get traction, then we would need to seriously consider our options in terms of enforcement type action. But as I said, our goal is not to have to get to that point, and that trustees, when we put the information, if they're not already looking at it themselves, quickly come to the view that they need to take steps to address the issues.
All right, so in terms of, I guess, the new approach to the outcomes test, there's a range of different factors, but then in terms of the disclosure, we're looking really at fees and costs at the moment. So in terms of building that picture the transparency for members, shouldn't we be somehow looking at a way to put the fees and costs picture together with the risk and the performance net returns?
Well, I think that's one of the key issues is that, for example, and I'm not saying this is a piece of work that we're looking at right now, but if you go back a few years, there was the standard risk measure, and that was introduced to try and bring some elements of saying, well, okay, how do you compare across risk? We've been doing work in the fee space. Obviously, there's a lot of work that APRA is doing in terms of internally how a fund is going to drive the different aspects of these. I think they're all absolutely linked together. We work very closely together to ensure that we both know what we're doing in the space. And I think the performance reporting aspect is a really good area that we can identify, because we're very concerned or very interested to see how the performance is reported, how it's used, how it can be better employed for people's understanding, and to ensure that it isn't gamed. We're not necessarily saying that we're getting indications that it is, but just to have a look at that particular aspect and ensure. I'd also flag that we're looking at not just in the super space, we are in the super and managed fund space, so we're trying to ensure that there's consistency of approach whatever vehicle is being used.
Yeah, and I think whether this ultimately sort of flows through into changes to product dashboards, and it'd be really nice to settle and get choice product dashboards in place as well. That's not primary APRA responsibility, of course, but I think that painting that picture in a way that members can understand is really important, and obviously individual funds can do that, but there is a benefit in having some consistent approaches across the industry that draws the full picture together, and we think that is important. We will be consulting on some changes to reporting to us that will allow us to publish more and more meaningful information in a consistent way, and I think the challenge to the industry is what they can do to enhance the disclosure to members in a meaningful way across all of those dimensions.
All right, well, AIST will continue to work with both ASIC and APRA in order to try and build that picture and make it meaningful for members, as well as, transparent and comparable across the industry. So please join me in thanking Helen and Jed for their time this morning.